Well, let's focus though on the life insurance space. And Yash has been on top of that one. He's joining in to give us a quick revision of what the street was fearing with regard to regulations coming on the life insurers. And it's not come about. That's why we have few of these stocks that are celebrating. Yash, put into context.
Well, Nigel, the regulations that we're talking about are with respect to surrender value. What is surrender value? It's a price that is given to the policyholder in case of voluntary and early surrender of policies. Now, in December 2023, the regulator had come out with a proposal, which spoke about increasing the surrender value, and the increase was significant, about 2 times of what exists today. Of course, that put a significant pressure on all the life insurance companies. They were back and forth, and now finally, in terms of final regulations, what we have from the regulator is a watered version, a completely watered version of what had been proposed in December 2023. What the regulator has done is practically brought back the surrender value to the point as it exists today. So no increase in that sense across, the parameters in terms of time parameters for surrender value. Now what this does is it removes the majority of the overhang from life insurance companies in terms of a potential increase in what they would have had to pay to their policyholders in case of surrenders, and reduces the margin pressure also which could have come about with this particular increase. Now what the regulator said is that they will have graded surrender value, which means as the policy matures, the value of surrender would increase, but large surrenders happen between the 1st and the 7th year, and in this particular period the surrender value which has been assigned by the regulator is largely same as it exists today. Now 30% is the surrender value in the 2nd year as proposed by the regulator, 35% in the 3rd year, 50% between the 4th and the 7th year, 90% in the last 2 years. Now just to give you the comparison between the numbers in terms of what was proposed in December 2023 and what has come about now, in the 2nd year what was proposed was a surrender value of 83,750 on a 1 lakh premium annually. What has come about is just 30,000. In the 3rd year, that surrender value proposed was 1.67 lakh. What has come about is just 70,000. In the 4th year, 2.51 lakh. What has come about is just about a lakh and a half. 5th year, 3.35 lakh was proposed. What has come about is 2 lakhs. So what this means is that in the first 7 years, the surrender value remains the same as it exists today, and large part of policies get surrendered between the 1st and the 7th year, which means no significant impact on life insurance companies with respect to negative margins on anything on those negative lines.
Absolutely, Yash, thank you very much. But I guess as someone who also tracks personal finance, for me the question really is that who's happier today, insurance companies or those who are insured? Maybe the regulators really try to strike a balance, which is what it's all about. Thank you very much for giving us the detailed contours of the final surrender value norms that have come through. To talk about this and get some more perspective, we have Tarun, Chugh, MD and CEO of Bajaj Allianz Life Insurance joining in. We also have Gurmeet, Chadha, Managing Partner and CIO at Complete Circle with us. Thank you, gentlemen, so much for being with us. Mr. Chugh, let me open with you, and that's really the thought, right? First, the market also took this very negatively, thinking that surrender values will be increased by a big notch. But clearly, that's not what the regulator has gone with. It's probably listened to the concerns coming in from the industry. Tell us the business impact, because the calculations show that for the first 3 years, the 3 years is absolutely no change at all, and a small increase in the value that you have to pay to the policy holders after 3 years, 4 to 7 years. So to what extent does it impact companies in general, and maybe you in particular?
Yeah, so I think it's a good balanced approach, as you mentioned. The good thing is that both the customers and the companies have been taken care of in this. So the impact on company valuation should not be much. There will be a slight come down because a certain category of products will be slightly impacted. But having said that, see, what we have to understand is if you go to the background of all of this, life insurance is largely a long-term product. So the moment you try to do too much of surrender initially, when we did our math, first time I think this math was done for the sector, when we went to the IRDA, they also realized, and we were able to put it forward, that the biggest loser actually would have been the customer, because the IRRs would come out. Usually, typically, in these products, we invest up to 20-25% in equity plans, and that gives us the upside for customers. And now, given the fact the uncertainty on surrenders, which could, surrenders could happen next year itself or almost the same year. So as a result, we would have to invest in cash, overnight cash, where the IRR, hence you can make out, would be significantly different. So I think the balanced approach came out well. The IRDA has nudged the sector to come up with a separate stream of products which have higher surrender values, and a little bit has been adjusted to increase surrender values in the existing products. So overall, for the sector, it's fine, and I think the growth of the sector would have been impacted significantly as well. That would be also maintained.
Do you have a rough number perhaps for the sector as a whole? Which is the year in which maximum number of policies actually get sort of truncated prematurely? Do people usually do that in year 2, year 3, or is it seen higher in the later years? Because now the regulation is very clear that if you stay with your policy, the longer you stay, the higher the surrender value in case you need to terminate it prematurely. So what's the current breakup, a rough percentage, if you have that, in terms of the year in which we're seeing maximum surrendering?
So usually it is the 6th year. It's the 6th year when dropouts happen. And I think what has to be understood, these things never get discussed, and good you are asking us these questions. If I look at my own company, the average premium paying term of policies is around 7 to 8 years. So after 6th year, anyways, the surrender values, as you heard from Yash also, get a lot better the moment you're in the last couple of years. So that actually has very little impact on insurance customers.
All right.
Which is good.
Got it. Hi, Mr. Chugh. Good morning and good to see you in. And Gurmeet, thanks a lot for joining in as well. Mr. Chugh, I wanted to ask you, brokerages earlier, they were estimating anything between 400 to 500 basis point hit on the VNB margins for life insurers. That's if the earlier proposed surrender value had come into existence. Now, with these new regulations, that hit is entirely out, or could some hits still come about?
Yeah, the calculations were near apt. I think would have been even more, in fact, if you ask me. But with this change now, there is very little impact, and far, far lesser, if I might say. We are still doing the math. We are awaiting the final master circular. See, some product streams will be impacted. For example, in non-par plans now, there will have to be an asset share as well, which was earlier. The concept of an asset share has come. It's a new concept. That will impact a certain stream of non-par plans, but largely very little impact now. You can always change the mix, right, over a period of time.
Okay, got it. All right, Mr. Chugh, we got that. Let's get in Gurmeet as well into the conversation. Hi, Gurmeet. Good morning and good to see you in. Well, Gurmeet, tell us, what do you all like from the insurance pack? Which are the top stocks that you like, and if you could give us some rationale as well out there.
Sure. So I think this the word threshold premium getting removed from the final draft is a bit of a relief to insurers with high non-par share, as Mr. Chugh also mentioned, because the threshold premium essentially said that above a certain threshold of premium, the surrender charges can only be applied to a certain threshold, and above that the premium has to be returned, which, as you rightly said, could have impacted VNB by maybe 200 to 500 basis points. So that's why you see the guys with higher non-par, which is Max and HDFC Life, obviously showing more respite, at least in today's trade. I think Max has been doing very well. If you see 9 months of in terms of gross written premium, in terms of APE, I think they've done amongst the best. Also, one of their new product was Step, which is meant for the affluent segment, where you pay for just the terminal illness also, and there's an option of getting the premiums back. That's done very well for them. And they're both banca and proprietary models are doing well. Proprietary model actually grew 45-46% last quarter. And with Axis Bank infusing, almost 1,600 crores, I think eventually it will be Axis Life as things stand right now, improve the solvency ratio as well. So I think that's something we like. HDFC Life, has a little bit of a muted year post the tax, changes which happened in the budget. Also, Nigel, banks' focus has also slightly changed. Anyone with higher banca share is also getting impacted because banks are very, very geared up on deposit mobilization with the scenario you have. So I think we like Max. We also like SBI Life, which is more steady, and maybe HDFC Life in that pecking order.
Mr. Chugh, IRDAI has also said that no premium can be changed during the entire policy term of the contract. earlier, it could be changed after 3 years. Will that be a bit of a negative or a hit to the industry?
See, let me just tell you more about this. In saving plans, usually this is a non-issue. It rarely is an impact in the critical illness plans and in the health plans. Health plans, anyways, we do not write indemnity plans. We write only benefit plans. So then it will finally, so that's not a big part of the entire piece. So where it then starts hitting us is really the CI plan, the critical illness plans. See, the problem there is the reinsurance for these will become a little bit more difficult. We'll have to find it. The market will have to adjust to a different level. So usually earlier, for every 3 years, we could have looked at the critical illness payouts, and the premiums could be revised accordingly. That is not possible anymore. So it will impact that. We'll have to see how we can take benefit of that for the customer. Good thing is we can now do short-term health plans as well and short-term critical illness plans as well. So that, I think, will make up for this. And we'll have to see whether long-term critical illness plans can be even manufactured.
Mr. Chugh, just to go back to that earlier point and also to get a sense of the product modifications that you're speaking of, you said that the maximum drop-off happens in the 6th year. I guess that's also because of the way products have been designed, right? Because you're locked in for 5 years, you have to keep paying premium. And earlier it was also sort of, these were policies where the policy was being taken more from a, perhaps an investment perspective than pure insurance. And again, on that anyway, there's now a tax clampdown of 5 lakhs. So going forward, what are the product modifications that perhaps insurers will make? And will customers also have to be sort of educated that if you're a customer who perhaps wants to have flexibility of tendering in your insurance policy, before its term ends, then be ready to have a lower return product? Is that how things will evolve?
See, I think it is very difficult to predict. It's never easy to talk about what's going to happen, let's say a couple of years hence or next year, very clearly with the change of product guidelines. But what I can say is that a 5-year term usually is a pretty long-term term from an Indian mindset. If you were talking of Japan and other countries, they would usually sell 10-year, 12-year, 15-year products, and they'll be having very high persistency all throughout. In India, 5, given the way we work, given the way we think, we keep a lot of options open in front of our financial services plans that we've got. 5 years is long enough, and it's really the 6th year dropout, hence, will impact lesser. And as also I clarified that usually the 7th, 8th year is where most policies tend to get drawn out. What will happen is customers, with this regulation particularly, is that customers will have to be given more disclosures, which we're very happy with anyways. It will break down a lot of the mis-selling when it comes to long-term product selling. These disclosures, as you see in the regulations coming in, will result in people being more mindful of what they're getting. That itself will kind of bifurcate the market into 2 parts. One, somebody who's investing for the longer term, and one who's looking at maybe anytime surrender kind of products. So those kind of surrender products will also start coming. Initially, you're right, those new category of products will not have a very high IRR that we can currently give when we have longer term products, because like I mentioned, the LM has to be matched. You would not be investing in equities in that. You'd have more cash, overnight cash in it. That itself will have to be seen. I have a feeling over a couple of years that will stabilize, and the IRRs on those products also will come in. Currently, people will test waters with that.
Okay. All right. We're in for interesting times for sure. That is from the policy buyer's perspective. But Gurmeet, last word with you from the investor's perspective. Which life insurance stock would you want to buy now? Now that at least this one overhang is out of the way.
So as I said, Surabhi, we have Max, SBI and HDFC Narivad. In fact, Bajaj Finserv, which is not really a pure insurance play, it's a play on other sectors, also gives a lot of valuation comfort. If you see the growth in EPS for last 2 years and price performance, I think it's been quite subdued. Also, I think there's something which I'm talking other than this news is this Bima e-Sugam, which is a marketplace for insurers. I think that will eventually lead to more transparency, more interest being catered for everybody in the value chain of insurance, including investors, intermediaries, and providers, and its impact on policy bazaar. I think that's something which the marketplace is something which is I want to see more other than the draft guidelines. Because PB FinTech has turned profitable. If you see even 9 months now, they are profitable. And it's a very asset-light model. And their credit business also now is picking up pace. So if you see their trail, which is what you make on mortgage on an ongoing basis now, contributes 15% to the overall credit revenue. So the trail is also picking up. It makes the annuity flows more stable. So that's something I'm tracking more other than this.
Gurmeet, great you brought that up. Actually, PB FinTech is doing very well right now, almost 4% higher. And I want to get Mr. Chugh's comment on Bima Sugam as well. But just to complete the point, Gurmeet, so doesn't a new platform like this, where all insurers have to come through and it's been put together by the regulator itself, doesn't it offer some sort of higher competition to a platform like PB FinTech? Right now, the stock is showing no concern at all on margins, on commissions. But just your views on this.
So, I think you have to see, it's like ONDC versus Zomato and Swiggy, right? The platforms are always there, just that the market is huge and insurance is a technical product. Half of the terminology people don't understand. And PB FinTech has been working on even non-assisted sales. So one is the assisted sales you do, which is more phygital. And then is a non-assisted sales. So insurance, in my view, is still a complex product. So I think it will take time. And that's why I said I want to look at this space more closely and see what the impact would be. So anybody who's asset light, who's been there for a time would obviously have a first mover advantage. And any marketplace eventually leads to more efficiency in the market. That's my personal view.
No, fair point, and that's a very valid point that maybe it's still not that easy for people to go and buy policies on their own or DIY as they can do with mutual funds. Maybe that's a far more simpler product than insurance. Mr. Chugh, your view on Bima Sugam and how that changes things with the industry, and just purely in terms of the channels through which you will be now selling. What changes with Bima Sugam also coming in terms of insurance and just the whole distribution framework now?
I think Bima Sugam is a significant step forward. And IRDA, I think, is really being very pragmatic at looking at the way customers would want to buy things in the future. A significant segment of the customers will find servicing, claim handling, the process of Bima Sugam to be very smooth and far smoother than what they currently see. More so, it will bring in a lot of transparency in the sector, and transparency is equal to trust. So the more the trust in the sector, it will only just have a multiplier effect on the market growing. And that's what is really my focus. That's what I think will make a big difference, because today people, when they lock in their money for 7-10 years, aren't really sure. So the moment they see it available on a large platform, which is everybody together, they can see it for themselves, it will increase the throughput of insurance. I think that's really where I focus on. In terms of distribution, it's all distributors will be present on this as well. So the process for them also becomes easier. So I think there are no losers, there are only winners in this.
Okay, gentlemen, thank you very much for joining in. It's been an enlightening discussion. Thank you for your thoughts. We'll get